Hey, what's up, my friend? So, in today's episode, right, I want to share with you a simple trading checklist that you can use to help you better time your entries. So, first thing first, number one, the thing I look for is relative strength. So, let's say, for example, you trade stocks, okay? So what is relative strength? So, this simply means, right, how strong is a stock, right, relative to the index. So, let's say stock ABC this year, right, it has, risen 50%. Whereas the S&P 500 has only went up, let's say 10%. So in terms of relative strength, you can see that stock ABC is stronger than the S&P 500. And in this case, right, you want to look for buying opportunities, right, like stock ABC, because they have, proven themselves, right, that they are strong, right, in recent months. Okay, so same thing for currencies. If you trade a basket of currencies, you want to buy the strongest currencies and sell the weakest ones. So if you look at the currencies, one way to go about it is to use the relative strength indicator, the rate of change indicator. And what you want to do is just plot out the rate of change of a currency pair, let's say over the last 15 weeks or over the last 50 weeks, right, depending on the type of trader you are, how long your trades hold. So usually I go with the last 15 weeks of ROC value. I rank the currencies from strong to weak. Those with the highest ROC value, right, I rank at the top. So those are the currencies that I want to be buying, right? And those rank at the bottom are the currencies that I want to sell. So this gives me a idea, a sentiment, right, to know which currencies are strong and weak, and I can find the ones with a higher probability of the market moving in my favor. So that's for you, right? If you are trading FX, right, this is a tool that you can use. And again, the concept can be applied to stock as well. Can you find out what's the stock ROC over the last, let's say, over the last 50 weeks, right? Compare that against the S&P 500. If the ROC value is higher than the S&P 500, those are the stocks that you want to focus on. Basically, the higher the ROC value, it basically means that it's stronger, okay? So that's the first thing, right? Relative strength. Want to be buying the strongest markets out there and selling the weakest ones. Number two, the trend, right? The trend is your friend, right? So pretty common sense. So you want to be, let's say if you want to look for buying opportunities, then needless to say, you want to be buying in an uptrend, right? So make sure the market that you're trading, let's say it's above the 200-day moving average, above this long-term trend following indicator. All right, that's one way to define the trend. You want to make sure that you want to buy in an uptrend and sell in a downtrend. So that's the second thing, right? Looking at the trend. The third thing is what I call the area of value. So this could simply mean, right, where could potential buying pressure step in. So yes, just because a market is in an uptrend, right, doesn't mean you're going to buy immediately, because the market could be going up for the last 5, 6, 7, 8 days in a row, right? So what you want to do is to let it come to an area of value, and this could be things like support, this could be things like a trend line, this could be things like a moving average, right, where the market could potentially find buying pressure at this area. So this is what I mean by looking at the area of value. Number 4, entry trigger. So this is what will get you into the trade, right? What is the thing that you're looking for to kind of confirm that, hey, the market is about to reverse or go into my intended direction? Could be simple things like candlestick patterns, if you're familiar with, like a hammer, a bullish engulfing pattern. Okay, that's number 4. And number 5, proper stop loss, because you can have the best entry trigger out there, but if your stop loss is crap, like a 5 pip stop loss, 10 pip stop loss when trading off a daily time frame, then you're asking for trouble. So your stop loss, right, must be placed at a level where it makes sense. So let's say if you're buying at support, the price comes into support, it forms a hammer and bounce up higher, you go long on the next candle open. Where do you set your stop loss? So ideally, right, your stop loss should go below support, because that is an area of value. You shouldn't exit your trade, right, until that area of value is invalidated, until that area of value is destroyed. So when will the area of value get destroyed? Well, if the price breaks below support, then it tells you that something's amiss, the area of value is not holding up, and you better get out of the trade. So your stop loss should go below support, like for example 1 ATR below the low of support, right? So that's how you would go about setting your stop loss. And one final bonus tip that I have for you is what I call stack levels. So what I mean by this is that, let's say you enter your trade on the 4-hour time frame. Maybe you buy at support. Okay, there's a hammer, you buy at support, market is in an uptrend, yada yada. And that is not the only thing going in your favor, because on the daily time frame, right, you happen to realize that the area of support on the 4-hour time frame, right, is also coincide, right, with the daily time frame, let's say an upward trend line on the daily time frame. So this, you can see that there are multiple area of value coming together. The area of value on the 4-hour time frame, and then you have another area of value on the daily time frame coming together at a similar area, and that really makes that area much more powerful and where you can expect a stronger reaction. So this is what I call stack levels. And when you, I mean, it's not possible to have every trade have a combination of stack levels, but when you identify those trades where multiple confluences come together, those are really the trades, right, that can move quite a bit, right, in your favor. So pay attention to that as well. Okay, so with that said, let's do a quick recap. Number one, relative strength, you need to buy what's strong and sell what's weak. Number two, trade with the trend. Number three, trade from an area of value. Number four, look for a entry trigger to signal to you that the market is about to move into your intended direction. Number five, set proper stop loss. And number six, the bonus tip is to stack levels, right, where multiple area of value from different time frames come together, right, at a similar area. That's where you can expect a stronger reaction in the market. So with that said, I wish you good luck and good trading. I will talk to you soon.